What's going on, guys? It's Jimmy here. Welcome to our daily show where we discuss everything going on here in our country that you need to know about, including money, investing, the stock market, which is all going crazy today because of the Federal Reserve's major announcement here today, which is a major announcement for the first time in over 20 years that they have done something like this. And we're going to let you know what happened here today, how the markets are reacting, and how this is affecting your money, how this is affecting our economy, which is basically kind of crashing right now because of how bad inflation is. It's crazy right now. And will this help gas prices and food prices, which are at all-time highs right now? Well, let's go right to the source. Here is Federal Reserve Chairman Jerome Powell with the announcement. Check this out.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective.
Okay. Wow. There's a lot to talk about here. First things first, probably the biggest one here is that the Fed hiked interest rates by 0.75%. We had a couple analysts predicting this. This is the largest interest rate hike since 1994. That's almost 30 years. Yeah. Yikes. That is considered a triple interest rate hike, 325 basis point hikes. Yeah. This is also the third interest rate hike this year. They did a 25 point, a 50 point, and now a 75 point. And I believe that they're considering 3 more interest rate hikes this year. Yeah. Officials also significantly cut their outlook for the 2022, this year, economic U.S. growth, now anticipating only a 1.7% gain in U.S. GDP growth, down from what they expected, 2.8% from March. So that's like a 50%-ish, just eyeballing this here, reduction. Yeah. And according to the dot plot, let me zoom this in here for you. Yeah, the dot plot of individuals' members' expectations, the Fed benchmark rate will end the year at 3.4%, an upward revision of 1.5 percentage points from March alone. Remember that we were at about 0% with the Fed interest rates not too long ago. And you can see how quickly they are raising interest rates. They're going up quick. Yeah, just to kind of give you guys an example here, here is the current home mortgage rates. This is before the interest rate hike that just was announced today of 0.75%. So almost a full percentage rate hike today. Okay, you can see here 30-year interest rates on mortgages are almost at 6%. Basically at 6%. So these are dramatic rate hikes. And when we look at these, I mean, literally just a few months ago, they were at 5%. Now they're at 6%, and Google shows them now already going up to 6.6%. Yikes. Now the difference here of going from 5% to 6.6%, a 1.6% difference, is very dramatic, okay? And remember, this is going to affect credit cards as well. This is going to affect everything that you pay interest on that you're not locked into already. So anybody that goes to buy a new home or refinance their home, yeah, you can see the average US home price right now is $375,000 right now. Some of you guys might say, wow, that's really expensive. And some of you guys might say, in my area, that won't even buy a home. That'll buy a shack. So that's the average price right now. And, again, it very, very varies by state. Let me know what kind of home that would buy in your area. Would that buy a really nice home, a good home, decent home, or a terrible home? But we'll show you how much these interest rates are going to affect people here. They've already gone up 1.6%. They're going to go up even more here as of the 3/4 basis rate here today. So for round numbers, let's go with a 2% interest rate hike here. Remember, they're also going to raise interest rates 3 more times this year, most likely, as well. So just for simplistic math here, let's show what a 2% raise on interest rates will do to a home mortgage over the course of time on we'll go with a $300,000 mortgage. Remember, the average home is $375,000. Just for simple math, just to quickly show you how much interest rates matter, check this out. All right, so just for simple math here, just to kind of show you how much interest rates will affect people. The home mortgage, we're going to put in $300,000, no down payment, interest rate 4%. No property taxes, no PMI or anything, because we're not figuring that in. Interest rate 4%, and then we're going to do 6% here. Let's calculate this. Okay, you can see here on a $300,000 mortgage at 4%, you're going to see the total monthly payment is $1,432 per month, with a total interest paid of $215,000, okay? And a total of 360 payments of $515,000. I'll leave this up here in this window so we can see it. Now, in another window, we're going to do the same home at $300,000. But instead of a 4% interest rate, we're going to do a 6% interest rate. Okay, if you're refinancing your home or you're buying the same home, this is why if you've watched my channel in the past, I told you refinance when rates were low. This is the same thing with credit card interest rates here. This is why interest rates really matter. Okay, this is the same home. Instead of an interest rate of 4%, it's at 6%. Again, property taxes, PMI, home insurance, all at 0 because we're not figuring that in here because you still have to pay that either way, right? Now, the monthly payment here, the monthly payment is almost $1,800 on the 6% mortgage, $1,798. On the 4% mortgage, it was $1,432. So look at the difference there. Let's bust out our calculator here. 1,798 minus 1,432. The difference is $366 per month for the exact same home. And the only difference is a 2% interest rate hike. And that's what basically is pretty much happened already. Yeah. And or if not quite happened already, it's going to, remember, we have 3 more interest rates happening again this year. And here's what really happens here. Check this out here. Over the course of a 30-year loan, you're going to, on the 4% interest, you're going to pay $215,000 in interest over 30 years. On the 6% interest loan, you're going to pay $347,000 in interest. Look at the difference here. $347,514 minus $215,608, $215,608. The difference is an extra $131,906 in interest. Look at that. So the difference of a 2% interest rate hike is people buying new homes now or people that didn't refinance or are refinancing now are going to pay an extra $130, almost $2,000 in interest over the course of their loan. Look at the annual payment amount, $21,500 versus $17,100. And the total of 360 payments here, $515,000 versus $647,000. Now, this little math lesson, for it's basically what it is. This is how money works. This is how interest affects you. Okay? This is how the rich get richer and the poor get poorer, for lack of a better term. This is how the real world works. If you ever want to start with a nice beginner book, buy the book Rich Dad, Poor Dad. You can get it off Amazon for like probably $10 or something like that, by Robert Kiyosaki. It's a really great starter book that I've read many, many times. Really good book to start off about how Robert Kiyosaki grew up with two dads, a rich dad and a poor dad. And ironically, his poor dad is a guy who was very well educated and worked a 9 to 5 as I believe, a professor, but was stuck in the rat race for many, many years. Where his rich dad went on to be an entrepreneur for many, many years and started businesses, but just understood how money worked. And this is exactly how credit cards work against you as well. So if you've seen how that interest worked against you with a home mortgage, but you have to, I mean, everybody has a home mortgage, right? It's better than renting, because with renting, you're basically paying almost 100% interest because you're throwing the money out the window per se, in a way. I mean, it's not really quite apples to apples, but you're not building any equity over time. Okay. Everybody has to have a place to live. Okay. But that those interest rates really matter. Those interest rates really matter. So hopefully you refinance when interest rates were low, which was only 6 months ago. If not, when interest rates go back low here some point in the future, whether it be a year or 2 or 3 down the road, jump on those interest rates when they go back low. But credit card interest rates, this is why it's very important to pay down your credit card debt when possible. I've talked about this in a couple past videos, because this is how credit card interest keeps you poor. And if you're paying credit card debt your whole life, it's actually just taking away your money, exactly like that math showed you. So if possible, try to pay them down and don't use them. Don't use them. Or if you use them, pay them off every month and they'll actually pay you rewards. And I know this is harder said than done, but this is just kind of some, math advice or financial advice, that I was given through reading some books and through, my father-in-law who's an accountant, and through people smarter than me. So this is just kind of how interest works. Math doesn't lie. And yeah, let me know your thoughts here in the comments. But interest rates is going to keep going up over the course of at least the short run. Central banks across the entire world right now are raising interest, raising rates to curb inflation. Just kind of the way central policy works. Yeah, so for the short term, you might need to tighten your belt a little bit, tighten your discretionary spending a little bit, and look at your budget a little bit. And let me know your thoughts here in the comments. I will keep you up to date here with everything. And remember, interest rates matter. Interest rates matter. So yeah, let me know your thoughts. Make sure to subscribe down below. It's completely free to do so. There's no interest rate on that. And after you subscribe, click the bell icon to get notifications when we go live. I will keep you up to date here. You can click this video here to watch my newest video on Social Security raises that just came out. And here's my newest video on stimulus checks for multiple different states that are going out here. And you can see that in this video. So click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.